As investors continue to deal with inflationary pressure on the stock market and corporate earnings that are just beginning to show some slowing growth, what exactly is the fair value for stocks? Well, our chief equity strategist and economist, John Blank, is here now to give us his assessment on that question. John, you recently wrote that while the bull story remains intact for the market going into year's end, S&P 500 stock valuations may be getting a little bit of a haircut. What does that mean?
Yeah, Terry, we're talking on the 18th of November, Thursday, November the 18th. I got the S&P 500 at 4670 as I'm talking to you, and I cannot generate anything more than 4350 for the S&P fair value at the end of this year. So that is not a huge haircut, Terry. I think that's the main point to point out here. A lot of people are talking about overvaluation, but it's probably an 8 or 10% haircut, not more than that. In fact, for all the talk about the Fed's money printing and push pressure on the valuations, which is indeed true, we're only looking at 8 or 10% possible pullback.
Are there specific valuation metrics or indicators that you follow?
Yeah, I consider the 5-year forward PE on the S&P 500 at 18 as the thing that I consider to be fair value. The market right now is trading around a 20 or 21. So that's exactly the example of where the valuation metrics apply. And my thinking, and those go straight through to the top line of the S&P 500.
November is typically a better than average market month. As we sit here and talk on the 18th of the month, do you expect it to be the same?
Well, if we look at the month for the S&P 500 as we talk on November the 19th, the S&P 500 is up 2.8% for the month. And if you do, let's call it 3%, that's a 36% annual return, which is not what the market's doing, about 25%. So, yeah, you have to think that this is a pretty strong month, but it's not going to be so strong that it's going to be, noticeably different than other strong months we've had this year.
Do you think investors are beginning, with all the talk out there about inflation, to get more concerned about it at this point?
No, they are not. They are being assuaged by the Fed money printing to ignore it.
Is it me, or are we getting some confusing news from bond yields about where the market is headed?
Well, this is exactly what's going on. The bond market is going nowhere because the Fed's compressing yields. And so in general, the bond yield, particularly the 10-year, would reflect the core inflation rate, which would be actually 4 or 5% right now if the Fed were not doing what it's doing. But given the amount of money printing that has gone on, as well as the size of the government's debt on its books, they simply cannot let that long rate rise to 4 or 5%. So they're going to sit on this rate no matter what happens for the foreseeable future.
And with this in mind, and with Fed taper in the offing, what do investors have to keep in mind when buying into the market?
That the ECB is actually still involved in, pushing the market up, and that there really is a story outside the United States to pay attention to, along with the Fed.
And with not much time left to 2021, should investors be more concerned about 2022?
They should be only concerned about 2022. I think the main point, as you and I have always understood, talked about repeatedly, that does need to be repeated, is markets are forward-looking. So while we're on November 18th, 2021, this market has totally priced in pretty much all of 2022. And as it enters July or January of 2022, you actually may even want to bother with 2023.
That's interesting. Strong buy stocks on your radar now include Advanced Micro Devices, the Blackstone Group, and Chevron.
Well, let's talk AMD. AMD was a trash chip stock for years. 2017, I had at $15 a share. Looking at $150 a share, just a parabolic rise. This year alone, from $80 to $150, it doubled. This is the story of the chip market. Looks like it's fair valued given its earnings profile, but I probably would be, getting out of this stock. If I had it, I'd keep it running, but I certainly wouldn't get into a new position here. Blackstone, another incredibly strong stock, entered the year around $60 a share. We're now looking at $160 a share. Just unbelievable pressure to push this stock up the hill. You've got to worry again about not putting new money to work, but I probably would let Blackstone run if I had it as a security in my portfolio. And finally, Chevron, of course, the energy names have bounced back after the big compression during the COVID shutdown period. You've got Chevron at 115. It was down in the 70s, again, a doubling off the lows in 2020. But I would say again here, this stock is back to its normal range in the pre-COVID area, and there simply is no upside from here from Chevron. So these are three names: Advanced Micro Devices, Blackstone, and Chevron, where I basically would let the market keep running higher, but I would keep a shell stop on all these three, and I just get out of them if they tank more than 10%.
Chief Equity Strategist and Economist John Blank on the market with John. I'm Terry Ruffalo. Don't forget, find out how you can get the book Finding Number One Stocks. Now, in this 300-page hardcover, Zacks Executive Vice President Kevin Matris reveals almost every stock-picking secret he's learned from the system that since 1988 has more than doubled the average yearly gain of the S&P 500. Find out more at zacks.com/promo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.